I'm Karl Kyler, your San Diego Realtor, and I'm back with Matt.Kish of Movement Mortgage. And we got two very hot topics to discuss with you today in regards to affordability. Affordability has been the main problem for the last couple of years, especially as interest rates went up. Well, President Trump has proposed two possible solutions. We're going to talk about it today. I think we might even debate it a little bit. Let's go ahead and just dive in. Matt, real quick, can you just give us an update on where mortgage rates are right now, what they've done since our last call?
Since our last call, they've kind of ticked up again. A lot of volatility with no real data, right? A lot of rumors about jobs, a lot of rumors about where the economy is. There's a lot of states out there that are looking towards even recessionary measures. So there's a lot of talk out there, but there's no data, right? So hopefully before the year turns, we get some kind of data in the form of jobs numbers from the BLS or something showing kind of where the economy's been, where it is now, where it's headed. But we haven't had this information since the shutdown. So we're really data poor and rumor heavy. So it's keeping these interest rates, kind of flat. Not to say they've fallen off a cliff, but they've not come down. They've not hit a mark to where we're like, yeah, we're celebrating good rates.
Yeah, with the government shutdown coming to an end, hopefully these avenues of data will start to pour in. We are just 3 weeks out from the next Fed meeting where they'll decide whether or not they're going to do another Fed funds rate cut. And as we get closer to that, we should see some impact on the markets one way or another. Most likely, we usually experience it beforehand. But if you're interested in knowing what the Fed fund rate cuts and hikes, how those impact mortgage rates and how they have impacted home prices, check out the most recent video or one of my more recent videos on that very topic. I go through like a whole historical perspective on what they've done since the early 2000s. I even cover some stuff like pre-2000s, just so you can see the trends. But let's go ahead and dive into the two hot topics. Okay, number one, the 50-year mortgage. Now, I'm very excited for this topic. I think, Kish, you're going to push back on me. Let me just give you a little bit of background. In the early 20-teens, I was contracted for Fannie Mae and Freddie Mac for a servicer to do loan modifications. So people who were going into default and who were going to lose their home, there was a loan program back then, or a modification program, I should say, called the HAMP modification, home loan modification. And what we did is we extended their mortgage out to 480 months, which is 40 years. We brought their rate down to 2% with a step rate arrangement over, I think it was 7 or 8 years. So we started at 2% and then we capped at whatever market rate was, which back then it was like 3.5%. So they go 5 years for 2%. On the 6th year, they went 3%. On the 7th year, they went 3.5% or whatever that rate was, but we locked it up in advance. And this had a radical impact. Now that was two-tiered. So it was a loan extension as well as a rate drop. In this case, we're just doing a loan extension, but I've talked enough. Kish, give us the lowdown, give us the walkthrough of what a 50-year mortgage means for the consumer, what you think what your thoughts are on it generally.
My thoughts, personally and generally, are it's a smokescreen. Like it doesn't solve the problem. Our problem right now is a supply problem, which is hurting affordability, right? So let me take you back to a time way back when in 2020, 2021, when affordability became not the issue, right? When affordability with rates falling, what did that do to home prices, right? The same thing would happen here. What is that going to do to home prices when a big, vast group of people can now get into those homes? Where it doesn't solve the supply and demand problem. It kind of solves the affordability problem for sure. Right? Who's not going to want to save a couple bucks, on the front end, and which bank isn't going to want to just plunder on the back end, right? Like it's a win-win for the consumer and the bank, but it doesn't solve our problem. Our problem is supply, and having this 50-year mortgage only hurts that. Like more people into the buyer pool without any supply, what does that do to home values, right? So where are we at? We're in the same spot we're in. Now the banks are getting rich, right? So that's my personal view on things. So let's get to the technical view on things, right? So I, kind of ran the scenario on a chart that I'm looking at right now. And if you do it side by side, a $1 million purchase, 20% down, right? $800,000 loan, 30-year mortgage, right? In the first 5 years, you should pay that down about $50,000, right? Your $800,000 loan should go to about $750,000 after year 5. On a 50-year mortgage, you've paid it down $12,000, right? So let's fast forward. If you keep this loan to term, and this is at a 6.5% rate, mind you, right? Right in the middle, decent rate, kind of where we're living, on the high end of where we're living right now. But at a 6.5 rate for 30 years, right? You pay it off. Year 30, you're done. On a 50-year mortgage, you still got $600,000 to pay. So I ask you, does that make sense? Does that make it more affordable when after 30 years you're done paying, and after 50 years, 30 years later, you still got 3/4 of the way to go? How does that help affordability? I don't know, right? The only person it sounds like it's helping is the banks. And I'm a banker. I work for a bank. So bring it on, right? The more people in my pipeline, the better. But at the same token, I don't think it helps the problem. Twofold. Doesn't help supply demand, and it is a smokescreen on affordability, because it helps you ease into these things, but on the back end, you're never getting out of this hole, ever. I hope that was a long way to get a short answer there, Karl.
Yeah, it was, and I definitely feel for your position. I agree with it to an extent. I think one thing that you were pointing out, which is spot on, it's not solving the affordability issue in the context that we just need to build more homes. Well, my position is that we're not going to do that. The West Coast just doesn't. The state has put mandates on San Diego County to build, and we're not doing it. And the restrictions and regulations make it so difficult that they're passing laws. I think it was SB 79 passed recently, and pardon me if I got that number wrong, but allowed massive levels of density to be built around metro areas within a certain proximity to a transit area. And so I have an investor client who's been looking at properties, and we're finding there's this thing called the FAR ratio, FAR, and it's a multiplier. Now, typically in the metro area, you can build up to about 50% of the square footage of the lot. So if you have a 10,000 square foot lot, you can build up to about a 5,000 square foot home. But this FAR ratio is a multiplier, and sometimes you'll see a FAR ratio at like 6.5, which means if you have a 10,000 square foot lot, you can times that by 6.5, and that's how much square footage you can build on that 10,000 square foot lot. I just don't know, like, the cost to build in with labor, materials, access, and then regulations, time, the cost of money. I don't know that we can solve affordability by building houses. I would love to go that way. I really would. I think that the 50-year mortgage is not necessarily the solution, but a path or a tool for entry. So people are thinking, oh, well, if I get the 50-year mortgage, like you said, did you use 5 years or 10 years? After like first 5 years or something, it's like only...
I broke it down in 5-year increments, right? So
okay.
The first 5 years on a 30 is 50 years. The first 5 years on a 50 is, the first 5 years on a 30-year fix at 6.5%, you're going to pay off about $50,000.
Got it. Okay, perfect. My thought is, if we use the 50-year as a point of entry, it doesn't save a lot. If we look at the numbers, it saves like a few $100, right? Yeah, so it's nothing significant. It's nothing like, oh my God, this weight is lifted off my shoulders. But if it gets people into homeownership, it allows them to increase their income over time. It allows mortgage rates to settle down a little bit. It gives them the opportunity down the road to refi into a 30 at a lower interest rate when they're in a better financial position, and they don't have to pay out the 50 over the full 50 years. That's the position I think, or I should say not the position, that's the value I see in the 50-year mortgage.
And I see that as well, right? And we're all looking for a way to save a buck and get people into homes. But what you just said out loud and kind of described is a Cal HAFA program for getting first-time home buyers into places, right? It's not, it sounded just like that. So there are programs already out there that help you with this, and it doesn't break your neck on the back end. And also, if we're getting into these 50-year mortgages, what are the entry rates on these things look like, right? So I'm really interested to see what the other layers of this are, other than just like, this is on any given interest rate, this is what your payment might amortize at, and this is going to be the interest on the back end. I would like to see what other layers are going to come of this to kind of show how it's going to be more affordable than a 40-year interest-only loan or a 30-year fixed or anything that's already out there, or even a Golden State finance authority loan or first-time home buyer with CalHFA, because like I said, what you described is a CalHFA program for first-time home buyers, getting you in with affordability, letting you get you comfortable, maybe refi once without a fee to get you even more comfortable and keep that loan there. There are already things that kind of help you out with that. You just kind of fit into their box. But again, I'm on the side of whatever's going to help home buyers get into homes. I just don't want to see the banks being the ones that benefit the most out of it.
This is one of the reasons I've continued to call you and work with you, because you show such a high level of professionalism, and your level of experience and technical understanding of loans and everything is fantastic. You've provided great service. But one of the things I admire most is that whenever I describe you to my clients that I refer you to or refer them to you, I always say, he's really, really good at his job and he actually cares about you. So just hear him out, let him walk you through the scenario, because he's going to look out for you long vision. So I love that you have that mentality. It's like, I want the buyers to benefit, not just the banks, where I just think it shows a lot of heart. So my thought is, when the banks benefit, that means business is going up. I see kind of a domino effect there, but I do feel for your position as well. Now, let's talk about the second option. Another one I'm also excited for. You told me that it's already kind of pre-existing. Portable loans. Did I say that word, portable? Is that correct?
Yeah, okay. Portable. There's a couple of ways to say it, because different, like in the EU, they're already using it. Canada already uses it to an extent not similar to the EU, but both continents and countries kind of already have this going on to an extent. Okay, so essentially a portable mortgage, what Trump is suggesting is the FHFA posted an article, I think it's probably 2 years ago now. They talked about the lock-in rate. And the lock-in rate essentially suggests that there are these homeowners who bought in with sub 4% mortgage rates, and they're in a position where the market has gone up so much that they have all this equity in there, but because interest rates are so high and incomes have not grown proportionately to the cost of living, their ability to move up is they're handcuffed. They're identifying it as the golden handcuff rate, where they're kind of stuck in their home, and even for them to sell and rent, it's more expensive. It's likely more expensive for them to rent than just to stay in their home with a 3.5 or a 4.125 or something like that, because the cost of living has gone up so high. So they're essentially stuck. They're locked into their home. Trump is proposing portable. Every time I hear the word portable, and the reason I asked you if that was correct is because I think of porter potty. So he's proposing this idea of portable mortgages, so the homeowner can take this loan that they have, let's just say 4%, this loan, and say it's for $500,000, the remaining balance on their home. They can take that loan and move it to another property. Now, maybe you can fill in the gaps here, Kish. They're still kind of working through the details. Does the owner have to come up with the difference of the next purchase? Is there going to be a secondary loan market that will take a second position to that first at a higher interest rate? Are banks really wanting to do this? How are banks going to do this? Fill us in on what you know. So what I know is there's already a form of this that's available for VA buyers and sellers. It's called an assumable mortgage. Right? We've all heard of this, and a lot of people still to this day are trying to get into assumables. And what is that? Is you're looking, a veteran or an active duty member of our service who has their benefits on a property that they purchased, are looking to move, or they got deployed and they got to sell, right? And now you could get into their property and use the portion that they have left over at the rate that they bought it at. So if somebody bought in 2020, 2021, and they got a 2.5% rate and they have $300,000 left on that loan, you could assume that portion of the loan. But if they're selling their place for $1 million, you got to find financing for the difference, right? And financing for the difference at today's rate is probably going to be mid sixes, low sixes. So you got to finance that portion at that rate with a bank who's willing to do it, right? And so right now, just to be able to do the assumable, the current servicer on that hypothetical 2.75 $300,000 loan that the VA client currently has, that servicer has to give the thumbs up right now, right? Saying, I'll let this person from the outside assume your loan. We've taken a look at their credit, collateral, capacity to repay this loan, thumbs up, right? And you also have to get Bank B to agree to the terms that you're already on the hook for $300K, and now at that rate, and now you got to get another loan for, $600K at 6.5%, and you got to qualify for both, right? So that's a VA assumable, and that's something that's already going down right now. In Canada, however, they take both rates and blend them, right? And truthfully, I don't know how they do that, because you would have to get the banks to kind of commingle and agree upon something to where they both get paid. And the reason why we really don't have these portable mortgages yet, because Bank A, right, is still holding on to this money at a low interest rate, and they don't want to hold 3% for 20 years, right? They want to hold 3% for they want to hold 300,000 at 600 at 6.5%, excuse me, for 20 years, right? They want more interest on their dollar. So a lot of banks aren't going to be stoked about you coming and having a portable mortgage holding their low note for that term. So again, it comes down to the banks not being greedy. And so I won't hold my breath for that. But I think this is actually a great idea, right? That kind of helps everybody. But the only way I think it makes sense would to really blend that rate, right? So if you're buying a place, or you're taking the loan and you're moving it to a place, you got a 3% mortgage here and you're getting a 6% mortgage here. Now you got a 4.5% mortgage, right? I think we need to find a way towards that. The smarter people than me know that path, because again, the hard stop is going to be the banks, Bank A wanting to profit off that higher.
Yeah, there are some technical logistics that need to be ironed out for sure. I would imagine I do some dividend investing, and I invest in BDCs, business development companies. And one of the things they do, they're not as heavily concerned with rates as often. It is definitely on their peripherals and something that they monitor and watch. But they also make money off origination. And so they look at, like, they're not as discouraged when rates come down, because that means there's more business. They make money off origination, and they expect their loans to turn every 3 to 6 years. So I would imagine that the opportunity for a bank, circling back to what you're saying, like, no bank wants to hold a 3 3/4 interest rates for a full 20, 30 years or whatever it is, right? So I would imagine if an owner of that loan wanted to move and they wanted to take this advantage of this portable option, there would be some type of transfer fee that the bank is going to charge them to move that loan to the next property. And then the same bank may take the second position at the higher rate. So it's an opportunity for them to say, okay, cool, we don't want to hold this money, but here's an opportunity where we can charge a little bit extra on it to move it, and then we can get a second position on the same property with this buyer that we've already vetted, who's holding the money, and we can charge a little bit more on this second rate. And in the early 2000s, not that this is a fair comparison, but remind me if I'm wrong, I thought the second position loans tend to be a little bit higher back then, right?
It's 6 in one hand, half a dozen in the other. Because home prices were so low and rates were so high. So then when, equity jacked up really quick, you had this big stockpile of equity now, and of course seconds became a little higher than the first because the purchase price was so low, right? And then the equity became such a gain, and then when the housing market crashed, both of them crashed, right? So
Right.
during that little pocket of time, that could have been the case. But now, because home prices skyrocketed up, you're not going to see seconds being much higher than first, unless you were like close to free and clear for the.
Sure. Okay. Yeah. So bottom line, technical details, logistics need to be ironed out. Do you think that the fact that other parts of the world, the developed world, are already doing this, and the fact that we have VA already kind of doing this, I think the challenge with VA is that, yeah, we have the assumable option, but the seller loses their right to use the VA on the next property. I feel like I hear that conversation come up a lot, so there's kind of a caveat to that program. Do you feel like this is reasonable? Is this something that might actually be able to be implemented soon?
Reasonable, absolutely. Do I think personally it'll be implemented soon? Absolutely. I mean, look at it just like in terms of just everyday life. There's a reason why we don't have like high speed trains everywhere too, right? Because airline lobbyists and automobile lobbyists shot all these ideas down, right? So I have a feeling the big bank lobbyists don't want to see this happen, and we'll kill it before it starts.
Oh, interesting. So you think that it's just not profitable enough? So
No,
the banks, it's not advantageous.
Not at all. I think the banks like living at 6.5. Like the banks like living at 7. The banks like living at 6. The banks don't like living at 4 and at 3, right? That's just economics 101. If you could make more money, you should. And the banks are banks because they know that. So yeah, and when I say banks, it's kind of a blanket like statement. Like servicers have a big portion of this pie too. So servicers only make money by you paying that mortgage for a long period of time without refining, without doing anything funky with the loan. Just keeping that loan is what servicers want. So when you're bobbing and weaving and blending rates and doing stuff like that, the servicers don't make money either. So again, when I say banks, it's a blanket term. It's the bank that lends you the money. It's the servicer who's servicing that loan. It's everything in between. So banks, servicers, everybody that has incentive to make money off of your loan don't want any changes in it.
Yeah, I follow you. Well, I think that's pretty much what I wanted to cover today. It's like 2 hot topics that have been all over the media in regards to the housing market, with regards to addressing the affordability crisis dilemma, however you want to label it. Thanks for continuing to show up with us twice a month. If you have any thoughts, questions, or concerns, want to talk about loan options, opportunities ahead of you, I have Kish's contact info in the description below. Don't hesitate to reach out to him directly. As always, I'm Karl Kyler, your San Diego Realtor. I'll see you in the next video.